My name is Michael Guy, publisher of the Lead Lag Report. Joining us for the hour is the Mooch himself, Anthony Scaramucci, who I know a lot of people are familiar with. Anthony, I know a lot of people have seen you in the media, obviously, but I don't know how many people know your origin story. Talk about your background. How'd you get to markets? How'd you get involved with Bitcoin? What are you doing now?
Well, Michael, first of all, thanks for having me. I'll make it brief. I grew up in Port Washington out on Long Island. My dad was actually the crane operator in that town for 42 years. We had a very large sand embankment. And so he was basically a sand miner, hourly worker in a union. Went to a very good public high school in Port Washington. Then I went to Tufts University, Harvard Law School. My first job on Wall Street was with Goldman Sachs. I spent 7 years there. I left in 1996 to start my first company, sold that company in 2001 to Neuberger Berman. And then Neuberger was bought by Lehman Brothers. And I spent a few years at Lehman. And then in 2005, I left to start SkyBridge. And so I've been here at SkyBridge for 17 years, less my 11-day fiasco in the White House. And I'll address that quickly. I got into political fundraising as a younger person. I think I was 25 years old. I wrote my first check to Rudolph Giuliani when he was running for mayor. Why did I get into political fundraising? It was an access point for me. I didn't have a network to speak of. I'd never seen the inside of a country club or swung a tennis racket or hit a golf ball. And so it was a way to get access to wealthy and influential people. And so I spent a good 2 decades as a political fundraiser. And on the Republican side, of course, when Mr. Trump won, I forayed unsuccessfully into Washington. Happy to talk about it if you guys want. But less those 11 days in Washington, I have been at SkyBridge. When I returned from Washington, one thing I learned there, Michael, was that the United States Treasury was keen on understanding the blockchain, and they were debating at that time, and it's 5 years ago already, but they were debating at that time whether or not to digitize the U.S. dollar. And so after I got fired from the White House, I came back to New York. I told my colleagues we need to get up to speed on the blockchain, cryptocurrencies, Bitcoin, et cetera. The world is changing. We need to be a part of that change and embrace that change. And so it took us a while. We did a lot of research. We're institutionalists by nature. We made our first Bitcoin purchase, I believe, in October of 2020. I needed to see activity in Bitcoin. I needed to believe that Bitcoin, from a networking effect, was going to reach escape velocity. And I think our average cost in Bitcoin is about 18,000. And so we got below that average cost this weekend. But by and large, I'm super happy with where we are, and I'm super happy about the future. Even though price volatility being what it is, you've got a lot of great use cases for these cryptocurrencies and the blockchain going forward. And this is very reminiscent of March of 2000. Some young listeners on here, March of 2000 was a really rough time for Web 1. Where the NASDAQ cracked from like 5,400 down to 2,300. And this feels a lot like that, frankly.
What were some of the areas you focused on with SkyBridge prior to Bitcoin? Obviously, I know you do more than Bitcoin, but what were some of the main themes you were focused on when you first launched?
So my idea was I wanted to popularize hedge fund investing, and I wanted to make hedge fund investing accessible to people who did not have the ability to access hedge funds. So I'm taking you guys back 17 years ago. Hedge funds were really vehicles for the super wealthy, institutions, endowments, et cetera. And so my idea was I wanted to create lower minimums and create a feeder fund into a group of high quality hedge funds, a fund of funds, if you will. And so we did that. We created a registered investment company. We had minimum investments of $25,000. And you could come into our fund and get access to places like Steve Cohen or Dan Loeb, places that have $15 million minimums. And with your $25,000 or $50,000, you could get access to them. And what I was saying back then, which I still am saying, but it was catching on, was the notion that we would be the hedge fund manager for every dentist in America. We would If you had a net worth of $1 million, you wanted 5% exposure to alternatives, you could give $50,000 to SkyBridge, and we would then build you a diversified hedge fund product. We'd be your outsourced chief investment officer for your hedge fund investing. And that's worked out well. We have about 12,000 clients in that fund. All told, our assets are about $3.5 billion US dollars. 2+ billion are in hedge fund assets like that. We had over $1 billion in crypto. It's now down to about 700. We didn't sell any. It's just the result of market forces and the downside volatility of crypto, which we're obviously all experiencing right now. But it's been a great business. This is a lot of fun. I also have a conference business. Some of you may have heard of it. It's called the SALT Conference. We do conferences now in 4 different places. We did a cryptocurrency conference in the Bahamas in April. We do our flagship conference, which is now based in New York. It used to be based in Las Vegas. Our flagship conference is here in New York at the Javits Center. That'll be September 12th to the 14th. We have a conference in Singapore now in November, and we'll be back in Abu Dhabi doing a March conference in 2023. So those are fun events for us. They're also great networking opportunities for our colleagues and friends in the space. And I frankly enjoy doing them.
So you mentioned it started 17 years ago, and maybe for the last decade or so, it's been well documented that alpha has been hard to find, right, in the alternative space and the hedge fund space. And I know everyone chalks it up usually to the Fed and cheap beta, but I'm curious if you find there are other reasons for why maybe the hedge fund community has struggled to generate the kind of excess returns that people were maybe used to pre-GFC.
Well, there's a lot of different things that happened. Okay, I would say the decimalization of the Nasdaq definitely took out some of the spreads. I would say that the Fed's decision in 2008 to flood the system capital, we're seeing the reverse of that right now. Although I have to confess to you, if you look at the numbers, the Fed is still purchasing assets. Jerome Powell's on the TV today talking about raising rates, getting ahead of the inflation curve, but they're still out there buying assets. So it's a weird time. People have pulled their risk temperament back because of the perception of higher rates. But the truth be told, it's very unlikely that we're going to get way higher rates. In fact, we may get another 50 to 75 basis point rise, but it wouldn't surprise me at all if the Fed starts cutting rates by the end of the year because of looming recession fears or the fact that we're actually in a recession. So those are things that I don't think the market's fully anticipating right now. We'll have to see what happens. But yes, I think you're right. Decimalization of the NASDAQ, increased regulation around what was insider trading. The notion that Reg FD, the financial disclosure, where an analyst can't let one hedge fund manager know what the move is going to be before the others. We used to call that back in the day first call, where the top producing commission person got the first call in the morning about changes in recommendations from a sell side group. That can't happen anymore. There has to be instantaneous and full financial disclosure for everybody. And listen, a low interest rate environment like that, you start to lose price discovery. You have you're awash in liquidity. That rising tide raises asset prices, and so your shorts don't do that well, and you start to decline. You get a decline in alpha. Now, interestingly enough, Morgan Stanley is recommending more allocations to hedge funds right now because interest rates are going up. Markets typically decline when interest rates are going up, but then also concomitant to that, you may get some more price discovery or alpha generation for hedge fund managers. So, it depends on your frame of view and whether or not you're a long-term investor, Dan. And again, I appreciate talking to you again. Here's the thing I would say to you. I gave a presentation yesterday in Stamford, Connecticut. The best performing accounts at Charles Schwab are the dead people. Why are they the best performing accounts? Because they don't look at the account day to day. And so they lie dormant there, and that stagnancy, if you will, and that low fees, because you're not generating commissions and friction in your portfolio, you typically end up doing better. So the smarter, longer term cryptocurrency investors, I think, are going to do very, very well. You had and there are no, I think you know this because you're experienced, but it's worth repeating. There are no new mistakes. Everyone's making the same mistakes. So Celsius, Terra Luna, these are very reminiscent to me of the 1998 long-term capital management debacle, where there was an asset and liability mismatch, and the long-term capital had $4 billion in equity, but they had derivatives of 120. I think they were 1.25 trillion in terms of their overall exposure. You can't sustain that. Okay, of course that sees the markets. It causes a crumbling of the markets, and that's what's going on in crypto. These guys have mismatched their asset and liability books. But if you look at the trends, if you look at fundamental use cases, if you look at the volume of wallets, the explosion of ownership. Over 73 million people in the US now own some cryptocurrency. Almost a million people own a full Bitcoin. If you look at the transparency of these wallets, this is here to stay. This will continue to grow. And again, quite reminiscent of what happened to the Nasdaq. I know I said that earlier, but just think about it. Amazon went from 116 to 6. Many people said it was dead. Jeff Bezos said no. If anything, the use case for Amazon is growing, the user base is growing, the revenues are growing. Of course, Amazon went on to survive, and Jeff shot himself into outer space. He took Captain Kirk with him on a second trip. Point being, if you are looking at the fundamentals and you're disregarding near-term price shocks or that sort of volatility inducted by poor actors in the space, you still have a great long-term outlook. Still great long-term things are going to happen. I think what kills people is leverage. And so ultimately what happens is they like the idea, they like it better with leverage. And of course, leverage goes back and hurts you on the other side. I'm probably too old-fashioned now, 34 years in the business, experienced 9 bear markets. Um, we're unlevered. And so we're holding our assets, we have our inventory, and we have no intention of selling our inventory. If anything, we've been nibbling and buying some inventory at these levels. So I think people will look back 3 or 4 years, Dan, and say this was a historic buying opportunity, but most people will have been crushed and had very little liquidity to take advantage of. Yeah, well, I have said that often, and I'll repeat it here. If we were in an elevator together, and I only had a minute and a half to tell you about the blockchain or cryptocurrencies in general, what I would say to people, it's a massive delayering mechanism. And if you can disintermediate, you could take out the intermediation. You could take out third parties from transactions. You are going to have bundles and bundles of cost savings. And so examples that everybody uses are the restaurant. You don't have to go to American Express. You make a wallet to wallet transfer. Both you and the restaurant are saving that money. You could have a situation where you're buying directly from the producer of something. If we go through Amazon, you've got two parties. You've got Amazon, and then you've got your credit card company. But what if you could buy your deodorant directly from Procter and Gamble? Let's say you're using Right Card like me, and Procter and Gamble was accepting that transaction because they had full faith and trust that money they were receiving over the blockchain got to them. They could hire a cheaper fulfillment company than Amazon, something less branded. My point being is we could sit here and we could extrapolate so many massive cost savings and so many use cases. Now, one of the problems that we have is the industry is very nascent. And so we have a hard time doing that extrapolation. And so let me put it to you in a Web 1 context. Let's say we were sitting here in 1998. I had my fat box computer open, and I was dialing on to the internet using that very clunky modem, and you could hear the burring and the whirring as it was dialing in. And it took 35 seconds for my AOL landing page to arrive on my screen. And what if I came in from the future and I said to you, well, guess what's going to happen in 2022? There'll be hundreds of millions of people, if not billions of people, streaming 4K video on what we now call the internet. My point being is it would have been very hard to imagine or see that in 1998. But yet, look at the use cases, look at the proliferation of the applications, the social media space, et cetera. So Web3 obviously represents that colossal and exponential opportunity. And I think you'll be sitting here 5 or 10 years from now, when we're transacting, we're going to be taking a lot of the intermediaries out of it, and it'll make it more efficient and obviously save everybody on both sides of the equation some costs.
So I agree with the idea that you got to disregard price shocks, right? Because I always make that point that drawdowns only matter if you need the capital in the drawdown, right? Otherwise, you really shouldn't have to stress too much about it if you have a longer term thesis. But help me through this. Help me think through this a little bit, Anthony, because there's a dilemma that I see with the space I often rant about, which is it seems that the narrative changes almost daily when it comes to Bitcoin and other cryptocurrencies. And your point about leverage is spot on, because leverage is the necessary precursor for a crash. Right? We all know that it doesn't matter what asset class. And the problem that I see is that the narratives are so one-sided. It's an inflation hedge, Bitcoin. It's a store of value. It's the future, that you end up having such overconfidence and such over leverage that it causes these tails to present themselves more often than not. Talk about how you think the narrative should be framed for Bitcoin, because I feel like we need to enter a different kind of a construct to really prevent this leverage, which means preventing these false narratives.
Yeah. So, I mean, it's a great question. I'm probably don't have the best answer because I'm not a regulator, and I also I'm a libertarian, so I want freer markets and I want less constrained markets. And so, unfortunately, with that, there comes some of these exogenous risks of leverage and so forth. So I guess what I would say to you, you don't want to ban leverage in its entirety, because we need leverage in the system. It allows people to live the American dream, frankly. I could speak for myself. I couldn't have afforded my first house for cash. I would have needed to borrow in order to afford that and to space it out over 10 or 15 years to create the equity. So you don't want to ban leverage, but I do think you need to regulate the system. And I do think what's happened in cryptocurrency is double collateral. That happened in the 1920s in the stock market before the stock market crash. And of course, you used to be able to put 10 cents down to buy 100 cents of stock back in the 1920s. Now you have to put 50 cents down to buy 100 cents of stock. And I do think there needs to be some regulation and some limits on the leverage. And we have to have more transparency in the space to prevent the the double collateral, because, this is new territory, but it's old territory in many ways too. This is the introduction of fractionalized banking for crypto. And so you have to adhere to and follow some of the regulatory things just for the fairness, because what do we know about life? Greed always overcomes wisdom. And you're sitting there in a situation where people get very, very greedy and they start to do things that are big on the risk side, which lead to collapses. You also have to look at the Terra Luna situation and recognize, we wrote about this before it cracked. We said that was inherently unstable. You can't have definitionally a stable coin that is being stabilized with something known as Bitcoin that has an 80 vol. I mean, Bitcoin has now recently gone to 100 vol, which I do think makes it more evidence, frankly, that the bottom is close. If we're not at the bottom or passed by the bottom, we're near the bottom. But my point being is that, how can you stabilize something with something that unstable? And so it cracked. Somebody cracked it. Maybe we'll never learn exactly who did it, but somebody got out there and started massively shorting Bitcoin, and then triggered all the algorithms at Terra Luna, and Terra Luna dematerialized. But the point being is it was inherently unstable. Free markets are such that somebody had to crack it. It was going to go down. Celsius was going to go down If they didn't have the right protocols, right risk metrics, right stress tests in their business, well, then they would go down. So to me, I think the regulation comes in to make these things fair. Think of Basel III capital requirements for the banks, where the banks now have to stress test themselves pursuant to what's going on in the overall capital markets. One last point, and then I'll take another question. But I want to make this point because I think it's very relevant. You have to remember where we are with crypto. We are so new. 2% market saturation. Maybe there's 250 or 70 million wallets. Very unregulated, very unfettered. And so it shouldn't be surprising people that it's this volatile. We do need fair and efficient regulation, and hopefully we'll get it.
I'm glad you say all that, Anthony, because you strike me as somebody who's rational and logical, not sort of on the maxi side of things. Because when I interact with people that are very adamant about Bitcoin, there's this sense from them that it's going to be tomorrow that Bitcoin eats the world, and this stuff takes time. And I think that's where people get into trouble. It's not just sort of this asset liability mismatch of the industry. It's also a time mismatch in terms of expectations, which I think we can talk a little bit more
about. Well, no, not only have I met Sam, I'm partners with him. He's a partner with me on the SALT conferences. We just did an FTX SALT branded cryptocurrency conference in the Bahamas together. We shared the stage together. Our teams have worked together on these conferences successfully. I've spent many hours one-on-one with Sam, and I've gotten to know his parents actually very well, too. I would say about Sam, he's a brilliant guy. He figured out a way to make money in the arbitrage space in crypto, a very nascent space where you can buy and sell these cryptocurrencies on different exchanges and clip spreads and pocket those. And so he's a very well capitalized guy, and I think he's made a appropriate and smart strategic decision that some of these crypto financing vehicles, whether it's BlockFi or Voyager, that are in trouble, they're probably in trouble short term, meaning the liquidity dried up. Some of you may remember the Lehman Brothers debacle. Lehman Brothers actually, all they needed on September 15th, 2008 was a credit facility. They actually had the assets. They just, they needed to hold on until the bone-crushing deleveraging wave ended. But the United States government made a decision not to give them that credit facility, and so they had to seek bankruptcy protection. So in Sam's case, he's looking at these guys. Maybe they didn't handle their businesses perfectly. Maybe they were over-levered at the wrong times. But I think he's looking at these guys saying, okay, I can provide the liquidity stopgap here. I can shore up these businesses. And I think what that also does is it sends a signal to the cryptocurrency markets that someone's willing to step in. There's no FDIC for crypto. There's no deep-pocketed government step in. But what I said yesterday to Bloomberg is that he's acting the way John Pierpont Morgan, J.P. Morgan himself, acted in 1907. So 115 years ago, we had a banking crisis. There was no Federal Reserve. The banks were over-levered with loans related to the steel companies and to the railroads, the great technologies of their time, oil companies, et cetera. And, what ended up happening was a couple of banks started to go belly up and default, and J.P. Morgan stepped in with capital to protect those banks. That augured for eventually what became the Federal Reserve, so that we had a governmental mechanism that would do that. I think eventually you'll have that kind of governmental mechanism in crypto. So yeah, he's super smart. I think he's doing it for those three reasons you suggested. I think it makes him money. I also think it's to protect whatever balances or assets are on his balance sheet. If he's able to do this for people, I think the third reason is, he'll pick up customers. Remember, what do these cryptocurrency exchanges need? They need capital, but they also need customers. And so one of the reasons why he owns 7.6% of Robinhood and could eventually buy it, he could pick up 20 million customers. I'm sure he's looked at the BlockFi situation and realizes he can pick up customers that way too. So there's a lot of different things going on at the same time. But, everything I just said, if you're listening to this, should make you more bullish on cryptocurrency and more bullish on things like Bitcoin, because you have wickedly smart people in the space that are going to start to do some very significant, opportunistic, positive things as a result of the latest near-term negative price action.
Has that negative price action maybe delayed some institutions from adopting cryptocurrencies? I know it's still new, right? But if we go back to the point that it's unstable, it's a true free market, institutions presumably have to model out investment returns, even though we all know modeling is often never kind of comes to fruition. But do you think that this is going to delay the adoption? You'll get the regulation obviously sooner, but what about the adoption side?
I think it absolutely delays it. I think that the NASDAQ market crisis of 2000 delayed it. I think this will absolutely delay it. I don't think anybody's surprised by that, but I don't think it knocks it off course. I don't see how, it's a funny thing. I was making a joke to somebody this morning. The first thing the investment bank says to me is, "Oh, we don't do crypto. We don't believe in crypto." And then the second sentence is they tell me everything that they're doing in crypto. And that's what's going on all over the country right now. BlackRock says, "Oh no, we don't like crypto. We don't like crypto." And then they make a several $100 million investment in Jeremy Allaire's firm known as Circle. My point being is, yes, it will delay it. It will slow it down. It'll certainly, if you're at a cocktail party, it's the class. If you're in traditional finance, to tell somebody that you own crypto, that's the class. You can't say that. That means that you're stupid. These guys feel that they're vindicated by current price action in crypto, or what they should be saying is, okay, wow, we got a second great historical buying opportunity. Let's take advantage of it. So some of them will do that, and some of them will wait. That's human nature. Well, we agree. And let me just add, let me bolster what the statement that you're making. I guess late April, Fidelity made a decision that they would start offering crypto to their 401k clients. So I just want you to think of the magnitude of that. They have $7 trillion in 401k assets. There's $15 trillion in the US. They almost control 45% of the space. They're about Bitcoin, what they did for the stock market in the 1980s when the 401ks started to come into being. So your point is well taken, but there's evidence that there's a move afoot. We're going to refile our ETF. Greystone's trying to get one. Bitwise is trying to get one. Maybe the SEC will continue to deny these, but then there's a real spirit of hypocrisy because they just approved a short Bitcoin ETF. You've got several cash ETFs approved in Canada, a few ETPs, Bitcoin Cash ETPs approved in Europe. I'm not exactly sure why the regulators want to put the United States so far behind our global competitors.
Let's go back to how people should think about this environment and this decline. There's holders and then there's traders. And I've heard a lot of people that trade cryptocurrencies, Bitcoin, that will make the argument that it's the purest form of technical analysis you can imagine, right? Because it's purely about price action. From a SkyBridge perspective, are there certain things that you look at, that you analyze, that makes you say, okay, this is a buy point. This is where we should be maybe allocating more or allocate less. Talk about that aspect of the process.
I mean, it's a great question. I'm not sure if I have the best answer. We've made a macro decision. Hopefully, we're right about it. I've been humbled by life and markets, so I'm not going to sit here and tell you I'm right about something. Time will tell whether or not we're right about it. But we've made a macro decision. We've analyzed Bitcoin, even Ethereum, but just focus on Bitcoin for a second. And we've made a decision. If you have a 4-year position in Bitcoin, you make money. And since Bitcoin inception in 2009, take a look at any rolling 4-year period of time you made money. Now, maybe we won't this time. I don't know. But I feel like we're going to, because the fundamentals are there. And you can actually price Bitcoin fundamentally off the growth of wallets and the proliferation of use cases and applications. So to me, I think it's coming. And I think taking a 4-year point of view means you buy it and you sit on it and you ride it through the cycle. I put out on Twitter, I've got a lot of feedback on it. A few days ago, maybe it was last Friday, I put out on Twitter an article about the dead people at Charles Schwab and how the dead people just do so much better than the people that are living because they don't make changes to their portfolio, you know. And there was a great movie in 1999 with Christopher Walken and Sissy Spacek. Brendan Fraser was in it as well. And what happened was the family believed that there was a nuclear bomb about to go off in 1962 as a result of the Cuban Missile Crisis. So they built themselves a bomb shelter. And so they sat in that bomb shelter for 30 years. And at the end of the 30 years in 1992, Christopher Walken sent his son, Brendan Fraser, back up to the surface of the earth. Of course, their house was replaced by a porn shop. It was very comical. He goes up, and Walken says to him, the father says to him, well, here's the key to my safe deposit box. If that bank is still around, my stock certificates are in there. And so he goes to get the stock certificates. Of course, he has $75 million in blue chip companies like IBM and AT&T, et cetera, where the family didn't do anything with those other than hold them on deposit in a safety deposit box. And I always think about that because sometimes doing nothing and ignoring current price action is the best thing to do if you're right about the long-term fundamentals.
Let's talk about correlation for a minute here, because a lot's been made about the correlation of Bitcoin to the NASDAQ, and you and I both know correlations change. So the correlation's there until it's not, right?
Yes.
What do you think would break that correlation? Because it seems to me that this initial co-movement is largely actually because of institutionalization, right? We know that the moment you categorize something and institutions take it over and start investing in it, it tends to co-move to other things in that bucket. But what do you think breaks that correlation of Bitcoin to other risk assets?
All right. Well, let me just start out by saying that what I have learned in my life, and again, maybe it'll change at some point and I'll have to unlearn it, but what I've learned is every time that there is a crisis, everything that you think is non-correlated is directly correlated. And so there's nowhere to hide. Correlations go to 1.0 in 2008. They go to 1.0 in March of 2020. And in the last 6 to 8 weeks, they've more or less gone to 1.0. So there are some of my friends that view Bitcoin as a store of value or an inflation hedge. I hear them speaking about it on TV or even writing about it. But scientifically, if you're just looking at the data, that has not borne out. When I'm on television, I never say that it's an inflation hedge. I never say it's a store of value. I say it's an early stage technical asset. It's an early stage technology that is being adopted. And as it scales and reaches escape velocity, as you get to 1 billion users, you're going to be in a situation where it's going to be worth a lot more because there's a finite supply. Someday, could it be those things? Certainly. The same way Amazon became a way less volatile stock as more and more people believed in the story and became owners of Amazon and the institutions started to own Amazon, it became a way less volatile stock than its inception. So that can happen for Bitcoin. But the correlation right now makes sense to me. It's trading like a risk asset. It's actually outperformed the FANG stocks. If you look at it, Bitcoin has outperformed the FANG stocks. But saying that, what could break that correlation? A Bitcoin Cash ETF could break that correlation. That would lead to way more supply, way more demand with the limited or fixed supply, better regulation in the industry, more countries adopting it, not just El Salvador, but other Latin American countries. I just did a podcast with the senior director of business solutions at Brand. They are trading in El Salvador Bitcoin, but they're trading it on the Algorand network. Okay, so they've wrapped Bitcoin over the Algorand network because it's cheaper and it's easier. I think more and more of that is going to start to happen. So we're sitting here. It is a uh, uh, bonanza of developers and applications. There's a bonanza of capital from the venture capital space flowing into the markets, and yet we have the last vestiges of a dash pandemic, a calamity equivalent to the Spanish flu 100 years ago. We have the remnants of that pandemic causing massive supply chain disruptions globally, which we still haven't cured. And then we inducted 40% more dollars into the global economy. If you just look at M2 and the proliferation of dollar volume since April of 2020, we put 42% more money into the system. So if you have a supply chain disruption, 42% more money in the system, and Vladimir Putin, who's one of the largest energy producers in the world, declares war on his Eastern European former republic that's now on his border, you're going to have havoc in the markets. And so we got too much inflation. Larry Summers was ultimately right. We needed to have toned down the uh, fiscal and monetary policy stuff that we did during the pandemic. He thought it was too much. You could see that labor participation rates dropped. You give people free money, they'll stop working. That's what they did. Labor participation rate stopped. Employment is okay, but the participation rate sucks. And then, take a look at where we are. We got high inflation. Now, I don't think it's systemic inflation. It may not be transitory. It's happening longer than the Fed originally anticipated. But, those inflation numbers will probably start coming down August, September, October. The supply chain is starting to cure itself. The war will eventually end. That's what we know historically. Wars start and wars end. Could they go on for a long period of time? Yes. But if they do, if it's like Afghanistan, people make a structural adaptation to it. I don't think this war lasts the way the Afghanistan war lasted, but could it go on another 6 months to 24 months? Sure, we'll make that adaptation. So you could be sitting here a year from now, inflation is tame, supply chain is fixed, the Fed is cutting rates because they fear recession. Um, I don't know. That could be a really big opportunity for people, and it could be a really big opportunity for cryptocurrencies. I guess what I'm saying to people is get out of your atavistic primordial brain and start thinking exponentially as opposed to linearly about the future. And so we're doing that here at SkyBridge. We recognize that we're hurting right now from a price position, but where we're not hurting is we own all the inventory. And one Bitcoin equals one Bitcoin. We didn't sell one Bitcoin in this debacle, nor did we need to, because we're unlevered. And I think when this stuff comes back, we'll be in a great position.
That point on the correlation going to one is important, right? Because that's kind of the joke about diversification, right? It fails when you need it the most. And historically, the only thing that on average tends to not correlate to one when you have that drawdown, that risk, is treasuries. Right? You have that kind of flight to safety trade, and obviously this year has not been proven to be sort of the safe haven asset. Uh, Again, I'm sure you're focused on more than just Bitcoin. I'm curious what you make of the core stocks to bonds this year. Because this has been a real pain point. We all keep hearing about how 60/40 is dead, and bonds are in trouble, and stocks may or may not be in trouble. But speaking about changing correlations, do you think that bond stock correlation also soon maybe breaks?
What would break it?
Inflation, or maybe deflation.
See, to me, I think when the inflation numbers go back down, which I suspect they will. Remember, you've had the specter of deflation for several decades because of all the great technology. Technology has a deflationary effect on a society because it lowers costs, and we have more cost lowering coming. You've got real 5G coming, better drugs through immunotherapy and biotechnology, automation coming, self-driving cars coming. All these things will start saving us money and reduce prices around the world. So to me, I think all of that stuff is going to happen. I just think for right now, markets have a tendency to overshoot in both directions. Think of the irony, guys. The market booms while all of us are sitting in our houses in lockdown. The minute the pandemic ends, we correct by 30%.
It's even more accentuated when you look at small caps, right? Because they went vertical on the reopening as Biden got elected, and then they've just petered out on momentum really as the vaccine rollout was taking place. It goes to show you that it's never that obvious and never that easy, right? Except with hindsight, and markets tend to do things you never really quite expect.
Always. That's another reason why I beg people to stay on leverage. There's no reason, the leverage, buy a house, I get it, tie it to your income, pay it off over 30 years, but don't lever volatile assets. No sense in doing that, because ultimately what we'll do, it'll totally disrupt your life and it'll totally disrupt your lifestyle. No, look, we agree. I'm in that camp. I can't speak to the fundamentals behind Zoom. My guess is probably some of these growth stocks overshot on the way up. They're probably overshooting now on the way down. There's probably some normalized price that's fair based on their fundamentals and a good PE ratio for them pursuant to where the economy is.
How do you how do you communicate to your own clients, Anthony, the long term case for Bitcoin? So again, I'm trying to narrow down this point about how do we think about the proper narrative, right? It's high vol. I understand your point about it's nascent, but still you're going to have, I'm sure, clients that will say, yeah, it's nascent, but I just had a 30% drawdown. How do I deal with that, right? So just talk about that a little bit, because I think managing expectations is a big part about actually being a buy and hold investor.
Well, listen, you probably heard me say this. Everybody is a long-term investor until they have short-term losses. The minute they have short-term losses, they start to go bonkers, and they want to totally replace their financial advisor, or they want to change their discipline, or they become very, very fickle. And so my goal is to work with a small enough amount of my client's capital where it's sort of irrelevant, right? So think about my hedge fund business. If I have 5% of your capital and we're doing a pretty good job for you, you find that irrelevant. In my Bitcoin business or my cryptocurrency business, I may have 1 or 2% of your capital. So you have to coach your clients for certain, but you also have to size them appropriately for an asset like this. Something that's got 100 vol, I tell my clients, I don't want you to miss this. Own a percent of it. If I'm right, you're going to go 10 or 20 to 1. If I'm wrong, you have 99 cents left, which is not going to cause a permanent impairment of your capital or your lifestyle.
Yeah, and I wish more people would frame it like that, because it seems that it's either one extreme or the other. It's never in the middle, but it's the middle where you end up having the best type of investors and the best type of outlook for the future.
Yeah. And by the way, people have fired me because of my Bitcoin exposure. And by the way, it seems like 500 years ago, but it was only 7 or 8 months ago, November of 2021, where Bitcoin was at 69,000. Some of the clients that actually fired me were cheering me when it was 69,000, and they're firing me now at 20,000. And the point being is, if you have a long-term approach, recognize that Bitcoin will make you money if you can hold it for 4 years. You're not looking for the top or the bottom. You're just looking for long-term secular growth in something. You're going to do very well. If you're going to look at it every day, or you're going to let your emotions guide your decision making, or as the great point that you mentioned, the leverage forces your decision making, and you're making mistakes.
Is there anything that concerns you about the longer term adoption? You always have to think about the counter argument, right? So, what would be a counter argument to Bitcoin longer term, and how much does that factor into allocations?
Well, I mean, listen, if you told me that the Federal Reserve in the United States got religion and they were going to stop proliferating their fiat currency, and they were going to start to reduce the federal budget. They would then decrease the governmental outlays, which included defense spending and entitlement programs. And they were about to embark upon a conservative stance of fiscal discipline, and they were going to tighten up. I would say, okay, Bitcoin's probably going to become irrelevant. But if you really look at where we are at this point in history, I think you have to say Bitcoin is here to stay, but it's early. And if you want the return, you're going to have to accept some kind of really wide-ranging volatility. I don't see anything on the horizon right now that's going to derail the macro thesis of Bitcoin. But if you told me the U.S. government's had a change of heart and they're not going to print another $2 trillion to support their deficit spending, the government outlays, the infrastructure, I'll tell you, okay, I've got this wrong. I've got to switch gears.
Right. It's basically if you get to a point where the debt ceiling doesn't get raised, right? Because it's really sort of a function of discipline and austerity, which is hard to come by in a democracy where you get voted in for promising more, right? Which I agree with you on that. Let's go back.
Sure. Yeah, well, listen, I have a position in block. I have a lot of respect for Jack. He probably understands that better than me. I use that analogy of looking at the internet in 98 and seeing the internet in 2022. Jack just sees a totally different world than the one we're living in. He sees a decentralized world where there's a decentralized Twitter, there's a decentralized Instagram. There are more a proliferation of DAOs where people are working together in these decentralized autonomous organizations as opposed to these very big corporations. He sees himself as being a repository of these tokens and or cryptocurrencies where you're using a Jack Dorsey block wallet on your smartphone to hold your assets. That could be a digital representation of your art or your watch collectible. It could be a tokenized version of Amazon stock that's sitting there in that wallet. You see what I mean? And that's what he sees. Totally. So when he says Web 5, he's really just trying to provoke you. I would encourage you to listen to some of the interviews on YouTube of Jack, and you'll get his vibe. But he's basically saying to you, whatever you think, or wherever you think this may be going in the short to near term, it's going so much farther than you think. He's a true visionary. That's his point.
Anthony, what's the biggest piece of advice that you'd give listeners in terms of not Bitcoin, but investing in general? You've done this for a long time. You've been very successful. You've seen, as you noted, your fair share of bear markets. What's something that you think people need to keep the front of mind in terms of how to think about putting money at risk?
So, I mean, I don't want to get overly philosophical, but like, you have to understand the frailty of your brain. So you're living in a vessel that is arguably 100,000 year old piece of technology. So, in other words, we really haven't evolved that much in the last 100,000 years. And so the neocortex, which is probably 6 inches long, 2.5 inches wide at the top part of your brain, that developed in the last 500,000 years. And it's only as thick as about 6 playing cards. And the neocortex is where you got your consciousness, and we can define consciousness in different ways, but it's basically we're able to observe ourselves. We're the only animal, the only species on the planet that's actually cutting itself open and looking inward to observe itself. And so I don't want to be overly philosophical, but you have to understand your brain is set up with a lot of primordial aspects. It's not like it just got designed for today's world. In fact, if anything, if we were designed for today's world, we wouldn't have so much obesity. We were designed for yesterday's world. And so you have to force yourself to do the reverse of what the primordial aspects of your brain want you to do. When markets are going down, the flight or fight response in your brain, you have an inclination to want to sell the markets. you should be buying the markets when the markets are going down. When the market's going up, you have a sense of euphoria, and you think that Bitcoin at 69,000 is the first stop on its way to 150,000. And so the first thing you have to do is recognize the frailty of the vessel that you're living in. And you have to work on creating control mechanisms for yourself, almost the way Odysseus tied himself to the mast while his fellow sailors were jumping in the water to make love to the mermaids, right? You have to figure out a way to do that. And I have found in my career, I wasn't successful at doing that when I was younger, but I'm way more successful at doing that now. And it's counterintuitive. It goes against the flight or flight response. You have to run towards things when they're down like this, not away from them. And that's ultimately what makes the difference, I think, in the world of investing.
Yeah, and also the reality that everyone always says you never want to catch a falling knife, but the reality is catching a falling knife is also when you tend to have the best longer term returns, right? Because it's always at the turn, right, when you get the most compounding effect from a longer term perspective. So I think that's very, very well said. So everybody that's here again, make sure you follow Anthony Scaramucci, obviously here on Twitter. Anthony, first time you and I are talking, I'm a fan of the way you communicate. I know my colleagues at Taroso have been to the SALT conferences, and hopefully I'll be on one on a panel one day at some point. But everybody, enjoy the rest of your day, and thank you, Anthony, for spending the hour here.
Real pleasure being on, guys. Michael, thank you. All right, we'll see you soon.
Thank you, everybody. Cheers.